Market structure shift is so key. It's basically how I get my entries. So let's try to break this down. So what we know from previous videos is market structure is either bearish or bullish or consolidating. So in a bearish market structure, price tends to move in waves like that. And in a bullish market structure, price tends to move in waves like that. So when price is moving down, obviously there are points where price is moving up. Now how does that, well, what does that look like? So typically what happens is markets tend to shift structure. So think about it this way. It's probably, if we even just join this, I guess like that, I guess something like that, you can see price is moving down, lower high, lower low, lower high, lower low, and then suddenly price will push up higher than the previous high, the previous lower high. Then it creates a new high, and then a higher low, then a higher high. So that is markets shifting structure to the upside. So you need to understand this, because this is basically how I enter the market, and you need to understand that different time frames, you have to consider all of that when markets are shifting structure. I'll get into more of that. So let's break it down a bit more easier. So market, let's say, is bearish, and we are going to then shift to potentially a bullish market structure. So what that looks like is we have lower high, lower low, lower high, lower low, and then suddenly price might shoot up high, higher than this previous lower high, and then come down and make a low, and then push up higher, creating a new higher high. Now how we mark this out, well, what I like to do is simply mark the previous high that was broken. Now when I say broken, that simply means price pushed up higher than the previous high, previous lower high. So we mark it like this. We can see that price breaks this high, causing a market structure shift. That's what I call it. You can also call it a change of character, change of structure, market structure shift. It's all the same thing. It simply means as price is moving lower and lower, we then start potentially breaking the previous lower highs and then start moving upwards. This is the exact same when coming down. When shifting to the downside, we could be moving, let me just move this over here. We could be moving up, higher high, higher low, higher high, higher low, higher high, higher low, higher high, and then we suddenly might shift structure to the downside. We break this previous higher low and go down, and then potentially we come up and then continue down, and then up and then down. So all of this is simply markets making higher highs and higher lows, and then shifting structure to become bearish, and then price reverses and then continues in the opposite direction. So in this situation, we mark out the previous low that was broken, so the higher low that was broken, and then price then continues further down. So when you become better after practice of marking out these highs and lows, you can see these shifts of structure, right? So this is just very crucial to understand, because markets can sometimes shift structure, and you need to know when they do that, where they do that, how they do that, and what it all looks like. Cool, that's that. Now let me show you something. What happens is, for me personally, when I look for my entries, first I identify my higher time frame fair value gaps, and then once price comes into that area, I drop to the lower time frames, so that could be like 1 minute time frame, and then I look for this pattern. So let me show you an example. Let's get rid of that. Cool. So this is the 3 minute time frame. Technically it's not really higher time frame analysis, but I mean, I guess we could change it to the 15 minute if you want. So let's just say we have the 15 minute time frame. we have price impulsively moved down. But let me just make it a bit easier for you to see. Let me drop it to the 1 minute time frame. Actually, let's do 3. I like that. Cool. So what we see over here is price was moving up. So we can see, look, higher high, higher low, higher high, higher low, kind of technically. And then we push up again to this high. And this is the last low that was created. So if we zoom in, we can see, look, we were doing higher highs, higher lows, higher highs, low, higher high, and then we push down. So what we do is we mark it out. We can see price broke this low and then pushed down. Now that might not have been a big market structure shift to the downside. It could have just been a quick little liquidity grab to continue up, but we'll get onto that. But what we see is price was moving down lower afterwards. So that kind of confirms that price is moving bearish. And then over here we can see price moved up into this fair value gap, and then we finally drop down. But to keep it simple, we can see again we have another break of structure to the downside. So the first structure that's broken to the downside, we call it a market structure shift. And any further ones that continue are considered breaks of structure because it's just continuing the direction. So in this scenario right here, we come up for a liquidity grab into this fair value gap and then continue down. We'll get onto that in the next few episodes. Don't worry about that. And that's when I'll talk about like fake market structure shifts and how to identify them. So over here, just simply, let's just look at market structure. We can see we have a market structure shift to the downside. We break this low. Then we continue up to make a lower high, and then a lower low again, then a lower high, then a lower low. Cool. So that's what it kind of looks like. So typically, if price is coming down like this, you want to sell as it retraces to continue down. But then we actually have finally a big major market structure shift, and this is what is crucial to understand. And what I'm going to talk about now is when you mark out your market structure and your fair value gaps, these are bigger zones, right? Once price gets into that area, you need to find an entry, and how you do that is you look for the same pattern, the market structure shift that we spoke about, something like this, or obviously the opposing one, which is something like this. You will look for that on the 1 minute time frame, or just like 3 minute or the 5 minute, very low time frames. You look for that within the area of interest on the higher time frame. So on the 3 minute in this scenario, we can see price impulsively pushes down. That tells me that there is a lot of volume in this market over here that is trying to sell. Cool. Once we've identified that this market is really pushing down, it's breaking structure to the downside, so we have this low over here. We can see it's broken that. Oops. Why are you doing this? Okay. So we've broken that structure to the downside. We've broken this low over here. We've broken this low over here. Now, we didn't actually break this low over here. However, there was no fair value gaps in this area down here for price to reject off. So I'm not going to be expecting the bullish market structure to continue because we were moving bullish kind of. But the thing is, how to identify basically when the next low is probably going to be broken is that there aren't any fair value gaps to the left. So if we are rejecting from an area and there's no fair value gap to the left, then potentially we'll just continue straight through it. And we'll get onto that in the liquidity episodes, so don't worry about that, I'll speak about that. But let's keep it a bit simple right now, simply just following market structure. Forget about all of this to the left. Let's just look at this price action over here. So we have a market structure shift to the downside, retracement up, break of structure again to the downside. Then we have a bit of a higher retracement. Again, this is a liquidity grab, we'll talk about that. And then price impulsively moves down, breaking structure to the downside. So then we understood from our market structure lesson that we need to retrace more than 50%. We spoke about this premium discount, pricing, and market structure and how you use that. So over here you can see that price retraced, pushed down, and then started retracing up, and then started continuing down. How would you have entered this trade? You could have marked out this fair value gap right here. The reason you would mark out that specific one and not this one down here or any that were further down, you mark out from your Fibonacci tool from the high over here to the low over here. So we can see that this fair value gap is very, very nicely placed above 50%. So we know that this is probably a good one to use. But let's say you don't know which one's good to use, right? It's above 50%, but we have one up here, we have one up here, and this is still a big zone over here. Which one do you use? You drop time frames. Once you drop time frames, you look for your market structure shift. Once we tap into a fair value gap, so let's say we tapped into this 1 minute fair value gap over here. So let's get rid of this. We tapped into this one right here. Once we tapped it, did we break any structure to the downside? Because this is the low, this is the high. We've just retraced down and then continued up. We didn't break any structure over here, so technically I'm not going to be trying to sell. I'm not going to try and sell over here. But let me mark up the higher fair value gap, which is over here. And what we can see is once price taps into this area, we start getting some sort of rejections and start pushing down. Now there's no clean market structure shift yet. When we see price retrace up and then push down again, we can see that we broke this clear low. Right? We've broken this low, clearly broken it and pushed down further. And then we mark out 50% from up here to this low over here. So this is the high, this is the low that's broken this low. So we mark out our Fib tool, Fibonacci tool, and we mark out where 50% is. And then any fair value gap that's sitting above 50%, those are the ones we're going to be targeting. So, and that's sitting right here. So right there, we mark up this fair value gap. And that's where you would take your sell and your stop loss above the highs. You can either use this high over here or just the overall high of the market that was created after touching that fair value gap. Or if you want to just be even less riskier, you can just put it all the way above the actual fair value gap, but that's not something I'd recommend. I would just recommend following market structure. Because if market structure is shifting bearish, there's no reason for price to then continue up even higher when there's not really much sitting over there. We've tapped into our really high fair value gap that's in a premium area. We've rejected it. And then we see a market structure shift to the downside. That is confirming to us that potentially we are shifting bearish. So over here we were pushing bullish, but then now we are shifting bearish. After having tapped our higher time frame fair value gap in a premium area, so that's where you would look to sell. And then you would be targeting the previous lows. So this is how this trade would plan out, and this is actually the one that I took this morning. Now, if we mark out our market structure with just this tool right here, let me get rid of this magnet. Look, we can see price is, let's say, coming up here, higher high, higher low, higher high, potentially a low that broke this low, but nothing clean. Then price retraces up and then continues down lower. That's confirming to us that we have market structure shift. This high over here where you take your sell. So I've just marked out this market structure, right? Let's just move it up. Do you see what I see now? That looks awfully similar to what we were talking about over here. This is what we were talking about, this type of pattern. Market structure shifts, so as we're pushing up, then we finally have a market structure shift to the downside, and then we start pushing down. This structure right here that I just marked out for you, all of this, looks very similar to this. Now, this is what a market structure shift looks like. And you look for these market structure shifts on the lower time frames. So the reason I say that is because it helps you with your confirmation that price is reversing. So let's say we have a 15-minute fair value gap over here. 15-minute fair value gap, right? Price retraces. So we're clearly bearish now, let's say, because we've broken these lows over here very impulsively. Market is bearish. But over here, price is pushing up, pushing up, pushing up. Now we have a 15-minute fair value gap. We push up into it. How do we confirm that the market is starting to reverse? So once you have your higher time frame fair value gap and you're pretty clear on the structure of the market, we are bearish because of this big bearish push that broke these lows. And then we have further liquidity down there, which we'll talk about. Don't worry about that. So we're clearly shifting, we are bearish over here. But as price is moving up, how do we look for that entry? We drop to the lower time frame. So I like to use the 1 minute time frame for my entries. Sometimes I use 3 minute or 5 minute, but typically I use the 1 minute time frame. As we can see, price taps into that fair value gap, rejects, retraces, and then pushes down, breaking previous lows. Once it does that, I'm just repeating myself because this is very, very crucial to understand. We retrace up into a fair value gap that is sitting above 50% of this high to this low, and then we take our sell. So this pattern right here, this market structure shift, it tells you everything you need to know. This is basically telling you that a market is potentially shifting to bearish now after coming into a higher time frame fair value gap. And on the overall time frame, let's say on the higher time frame, we are bearish. We are coming up into our fair value gap that is bearish, into our bearish fair value gap, and then now we are shifting back to bearish on the lower time frame. So it all works together. We have a higher time frame, bearish fair value gap. We are moving up bullish on the lower time frames, and once we tap into a higher time frame fair value gap, we start shifting bearish on the lower time frames. So that is indicating to us that the higher time frame is now ready to push bearish again. So that's where you're taking your entry. Don't worry, we'll look at more examples. Let me just randomly have a look at the market and look for some scenarios where the market shifts bearish. Okay, we have one here. Okay. So over here we can see market structure is very, very choppy. It's not, there's no actual, actually, you know what, we got one here. Right here. Moving sideways, cool. Price moves up, breaking this structure. This is where I actually got taken out, but point is, we can see market structure shifts bearish. It retraces into a fair value gap and then continues down further. So we were bullish over here, and then we shifted bearish, and then we come up and then continue bearish. Let me look for a better example for you. So over here, let's look at this scenario right here. Let's get rid of that. We can see market is pushing bullish. Higher high, higher low, higher high, higher low, higher high. And then we push down, we break this low. Let's mark that up. Right there where we broke the low, we can see price is now potentially shifting structure to the downside. And then we make this low over here. So if we mark out our highs and lows, we can see price is moving up, higher high, higher low, higher high, higher low, higher high, and then we broke over here, but then we pushed down lower, so we just mark out the low over there, lower high, and then lower low, lower high, and lower low. So if we take away this line, we can see price was moving bullish, and then finally we broke down, breaking this low, shifting structure to the downside, and then we continue bearish. So that's how market structure shift works. As price is moving up, making higher highs and higher lows, we simply just wait for price to break the previous low. That indicates to us that we are now going to be reversing and continuing in the opposite direction. That is basically how market structure shift works. I hope that was made clear to you guys. I'm trying my best to give you as many examples as I can and just talk about it more and more. Let's see. So over here, okay, we can see you know what, let me get off this lower time frame. It's probably a bit too messy for you guys. There we go. Okay, this is good. Right, so over here, this is another example. This is where price is actually shifting to the bullish side. So we can see price is moving lower, lower high, lower low, lower high, lower low. We have a little wick up, but basically moving down, lower high, lower low, and then finally we push up high. We push up higher than this high over here, and then we move down low, and then we are making potentially our higher low, and then we continue up to make our higher high. It doesn't look as clean as I showed you at the beginning, by the way. That isn't how the market usually looks like. That's just like the most optimal way of looking at it. But we can see overall that price was moving bearish, and then we pushed up, breaking the previous high, and then we continued moving up. So this is kind of what it looks like. On just this random chart that I just pulled out, just scrolling, we can see price finally pushed up, breaking this high, breaking this high, breaking this high. So that tells us that there are a lot of buyers involved in the market down here. So, and what we can see as well is a fair value gap sitting right there. We mark that out. So we mark out our fair value gap. Cool. And we can test that from this low to this high, we can see that this fair value gap is sitting below 50% of this entire move up. Right. And then we see price come back into that fair value gap, and then we can see it reacts to it and continues up to make a new higher high. So that is how market structure shift works. We were moving bearish, but then suddenly we get an impulse of buyers moving price up, shifting structure to the upside, and then finally we get a retracement into a fair value gap that was caused around about that area where the market structure shift happened. And then we see price come back down to it, and then we continue up. Now, I think in this scenario, in the lower time frames, it was a bit tricky to get an entry. So I'm just going to have a look quickly. What happened here? Okay, not bad. Not bad, not bad. Okay. So over here we have... Oh, this is good. Okay. So we have our higher time frame fair value gap marked out in a bullish market structure now, because look, we've pushed up, breaking these highs quite impulsively, and now we are coming down. As we are coming down, over here on the lower time frames, we are bearish. And what we're waiting for, once price taps into a higher time frame bullish fair value gap, is for the lower time frames to shift bullish. Once we tap into our area of interest, which is this fair value gap, sitting below 50% of this structural move. Once price comes into it, you can see price reacts off of it, but we're not really breaking any major structure, because look, the high is over here, the low is over here. Now we have this high made, and now we're just basically waiting for that to be broken. And then we can see price, actually no, price comes up close, pulls down, then breaks finally. Okay, so over here is where we finally break this high, and that to us is confirming that price is going to be shifting upwards. Now there are other ways to also look at this, which is a bit riskier, and that is these internal highs over here. So we can see as price is moving sideways, we are making some sort of market structure right here. We have this low over here, this high, this low, this high, but then suddenly price moves up higher, right? You can see that right there. For this move right here, it moves up higher than these highs over here, breaking structure to the upside. So once we break the structure to the upside, we can mark out our fib tool from this high to this high. And there isn't really any clean fair value gap here, but there is a 3-minute one. Not the best scenario right here. Our point is that we have our higher time frame fair value gap. Once price comes into that area, we wait for a market structure shift on the lower time frame, and then we start to push up. So what that looks like, we have a higher time frame fair value gap that is created with this big market structure, let's say. This is, let's assume, a big higher time frame 15-minute bullish market structure. Now we mark out our fair value gap, let's say on the 15-minute time frame, like that. Once price comes into this area, let me draw a circle, this is going to look nice. All right, this looks good. So let's assume we have our bullish market structure, right? Once price comes into our higher time frame fair value gap, which is sitting below 50%, the moment price comes into that area, what we are looking for on the 1-minute time frame, or 3-minute or 5-minute, is we are simply looking for price to do something like that. That's it. That's what we are looking for on the 1-minute time frame. It's all the exact same, the higher time frame and the lower time frame. We're just following the structure. So as price is coming down to that fair value gap, price is bearish on the lower time frame. So if you were to zoom in on the 15 minutes, so we have this 15-minute low that's coming down, and then we zoomed into this, it would look like, it will look something like that on its way down on the lower time frames. So once price finally taps into our fair value gap, we wait for structure to shift to the upside, and we can see that happens right here. We break this structure finally to the upside, and then even on the lower time frames it's the exact same. You mark out your fib tool from the high to the low, and we can see there's potentially a fair value gap sitting at this low over here on the 1-minute time frame, or 3-minute or 5-minute on the lower time frame. And then that's where you take your entry with your stop loss below the low, and then you just take your buy and you're targeting the next high over here. So what that would look like is something like that. That's it. So price, let's say on the higher time frames, is moving bullish. Once it comes into our area of interest, which is a fair value gap sitting below 50% of this market structure, we drop to the lower time frames once price taps into it. So this, imagine this is just zoomed in on the 1-minute time frame. We just look for this sort of pattern on the 1-minute or 3-minute or 5-minute time frame. Those are my lower time frames that I use. Once price gets into that fair value gap on the higher time frame, this is what we look for, this sort of market structure shift. I hope that makes sense to you guys. We'll be looking at more and more examples and how you use it all together, but this is just like a simple breakdown of market structure shift and what it looks like on, from higher time frame to lower time frame. So this is basically how I use it. You mark out your higher time frame structure, you mark out your higher time frame fair value gap, whether that's 15-minute, 30-minute, 1 hour, 4 hour, daily, whatever. You mark out that fair value gap within the structure. So let's say we are bullish, we have this big bullish move over here. You mark out your high and your low, and then you mark out your 50% fib retracement, and then you look for a 15-minute, 30-minute, 1 hour, 4 hour time frame fair value gap that's sitting below 50% of this entire move. Once you've marked out that fair value gap, you wait for price to come into that area, and then on the lower time frames you simply look for a shift of structure to the upside. So as we were talking about, we have bearish market structure, we have bullish market structure. You simply wait for price to shift. So that's it. We've shifted structure to the upside, and then continue up. So this is basically the pattern you'll see me draw quite a lot. Simply, this is just a basic market structure shift. I hope that makes sense to you. We'll go over more examples throughout the videos. Don't worry. Do not worry about that. We'll go through it. So I hope this makes sense to you, and I'll see you in the next episode where we talk about liquidity and how we use it all together.